Hello everybody, it has been a crazy week in the markets, and in case you haven't had the time to keep up with everything, don't you worry, because I'm about to catch you up on some of the highs and lows of the most important things that have been going on so far in the markets this week. We're going to start off with a lovely daily heat map in front of us. This is covering Wednesday's trading day, and as you can see, things are looking luscious and pretty and good. Take that down to a weekly heat map. Things are pretty much looking as good. Most major US indices had a little relief rally on Wednesday afternoon to close up in the green after the Fed handed us our July rate hike, which came in at 75 basis points. Now, while that might not be the best news for anyone who's worried about an oncoming recession, it was quite the relief to those that had gotten themselves in a bit of a flurry over a red-hot inflation reading a couple of weeks ago and were partially expecting a 100 basis point rate hike to hit. So that explains the little relief rally we saw on Wednesday. Analysts are warning, however, that declines could be yet to come. That's what happened the last time we got a rate hike. So everybody make sure you are taking everything with a pinch of salt. In the next couple of days. The European Central Bank made their move as well on the rate hike front, hiking interest rates for the first time in 11 years. The market was kind of expecting a 25 basis point hike. Instead, we got a 50 basis point hike, but that's okay because interest rates are now sitting at a whopping 0.00%. Yep, they have been in negative territory the last couple of years. So this is a pretty historic move. However, the ECB is a little bit behind the curve. Countries around the world have been hiking rates. The word rate hike is starting to sound weird, but have been hiking rates fairly aggressively the last couple of months as global inflation soars. However, they've joined the party now and are hoping that it will get prices under control. The IMF, however, is not feeling quite as confident. They have slashed their global GDP forecast and they say that economic outlook grows gloomy and more uncertain. Not exactly what we want to hear, however, at least they're keeping it real. How is the commodities market doing with all this, you ask? Well, if we look at natural gas, then pretty well. On Tuesday, natural gas prices hit their highest level since 2008 once again, after a brief little stint in the red in June. The commodity is now up 56% or so, 58% for July so far, after seeing a 33% decline in June. Russia's Gazprom this week has decided to cut gas supplies to Europe through the Nord Stream 1 to 20%, down from 40%, so a massive decline there. Gas prices in Europe are currently sitting at around 10 times higher than they were before the invasion of Ukraine. And to that end, Europe has decided to cut their natural gas consumption by 15% starting next month, largely to rein in Russia's control over the commodities market, which right now is wreaking havoc across the world, obviously in addition to a few other things. To that same end, officials over in the US are warning of a surge in fuel prices as they try to put a cap on Russian oil prices. The White House has decided to sell another 20 million barrels of crude oil as they try to get prices under control. Is it working? Well, a little bit. If we look at this oil chart in front of us, we can see that oil has been declining fairly steadily and slowly for the past 6 weeks or so. Now down about 9%, I believe, for July, 6.47. Things change so quickly in the markets. But that's enough of commodities news. We are in one of the juiciest weeks of second quarter earnings season, and a lot of that is down to social media platforms and their earnings. We are going to start with the bad news. Just kidding, it's basically all bad news. So we're going to start off with Snapchat. They were the first of the lot to report, and as you can see, they're kind of bearing the brunt of the pain here, declining 40% last Friday after missing on both ends of their earnings. As you can see from the chart, they have had a fairly sad history of dramatic declines here and here and here on the back of earnings. This quarter, they have put a lot of blame on a couple of things. The sluggish economy, which, to be fair, is hurting most people. A lot of competition coming from TikTok, which is something other competitors are struggling with as well, and Apple's privacy changes. So I'm sure you all remember last year, because everybody made such a song and dance of it, Apple changed its privacy policies. And all of that essentially made targeted advertising harder because it disabled tracking on iPhones. It has made a huge dent in the digital advertising sphere. It's estimated to have cut the average mobile advertiser's return on investment by 40%, which has led them to drop their mobile ad spend by about 25%. So wreaking some serious havoc across the digital ad market here. Twitter echoed fairly similar sentiments. They once again brought up the sluggish economy, TikTok, Apple's privacy changes, but with a few other complications sprinkled in. We would ask you to guess, but I think you all know where we're going with this. Elon Musk. They have said that costs associated to that whole drama came in at about 33 million. They also said that the whole thing is scaring off advertisers from advertising on their platform because nobody wants to get involved in the controversy, which is understandable to an extent. A couple of weeks ago in their court filing against Musk, they said that he is partly to blame for their declining share prices the last couple of months because they say he's been far too public about the whole ordeal on Twitter, of all places, and it's spooking investors. Which, if you look at Twitter prices, could be kind of true. Prices only went up 0.81% on the day earnings came out. At least they didn't go down, to be fair. But it does kind of show that investors are sitting in limbo here. They want to know what's going to go on before they make any sudden moves. Shareholders are voting on September 13th, so put that date in the diary because it's sure to have some dramatic outcomes. Lastly, we have YouTube owner Alphabet, who, hold your gaffs, missed on both ends. Are you seeing a trend coming out here? Because I am. So yeah, most missed on both ends of expectations. Obviously, on the ad revenue front, Google is one of the biggest, or arguably the biggest search engine in the world. So they did see advertising revenue on their search engine increase by 14%, largely from travel and food advertisements, however you want to put it. YouTube, however, which is sort of their social media platform, only saw 5% growth in their ad revenue, which was a massive deceleration. It was sitting somewhere around 64% in the same time last year. There was also a little bit of, a little bit of complications, a few complications thrown in by the strength of the US dollar. A lot of companies that generate revenue from overseas are struggling with that because they have to convert local sales back into the dollar, which is hurting their balance sheets. Meta is struggling with a similar thing. The big, great Meta has posted their first ever decline in revenue since going public. Revenues declined about 1%, which isn't the end of the world, but given their Meta isn't great news, they once again say that their ads revenue is really, really struggling and their competition with TikTok is getting more and more fierce. They've been trying to do a whole bunch of overhauls on their platform. I'm not sure if you saw how even the Kardashians are noticing that, complaining that Instagram has become too much like TikTok. Obviously, that's not even working for them. The whole metaverse thing isn't going too well either. Their Reality Labs division, which makes their headsets and the whole metaverse thing, has incurred losses of $5.7 billion this year so far, which is nowhere near the profits they've brought in. The profits are sitting somewhere around the millions. So a little bit of a black hole in Meta's balance sheet there. They still seem confident on the whole thing, but nobody knows. To make matters worse, Meta is also expecting yet another decline in revenue in the current quarter. So things aren't looking good. Now, speaking of expectations, we are going to touch briefly on retail earnings, which, not to sound like a broken record, are not looking good after Walmart gave investors a glimpse into the future and issued their second profit warning in about 10 weeks. Essentially, the message was inflation bites and it's eating into our balance sheet. Apparently, a lot of people, understandably, are more concerned with spending on essentials like food rather than splurging on clothes and entertainment and technology, and it's not doing retailers any favors. A lot of retail shares went down on Monday and dragged Wall Street lower with them on fears of what's going to happen when the rest of retail earnings come out later this season. We have Amazon reporting this week, so watch that one closely. Consumer confidence is, if we look at Walmart prices, we can see they dumped 7.6% on Monday, taking a bunch of others with them. Consumer confidence is down in the dumps. This is China, United States, United Kingdom, Germany. All of them have seen dramatic losses this year in consumer confidence, except, interestingly, India, where consumer confidence is up. So maybe something to look into there. Again, earnings week will continue in full swing the next couple of weeks. The rest of this week alone, we have got the likes of Apple, Intel, Tilray, Southwest Airlines, Pfizer, and next week some more big dogs. We've got Pinterest, AMD, PayPal, BP, Match Group, Lucid Motors, Robinhood, just to name a few. We've got a nice little earnings calendar here on TradingView if you want to check out what else is coming. Don't forget, we cover all of that and more on our Snaps page, and we send you an email, which is in your inbox every day by 9 a.m. So make sure you're keeping safe out there, everybody, and until we speak next week, always remember to look first and then leap.